Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Vishnu Varathan. He's the Head of Economics and Strategy at Mizuho Bank of Singapore. Vishnu, great to have you on the show.
It's a pleasure being here to discuss with you, Brian.
Now, Vishnu, before we get your sagely insights, let's take a look at how the region has been performing this morning. Now, Bursa is at 1,638.92. It's up 0.87%. The SGX is at 3,079.5. It's down 0.93%. Now, across the region, we've got, again, mixed. We've got Nikkei up 0.3% at 29,115.21. Shanghai Composite is at 3,381.84. It's up 0.67%. The Hang Seng is up 0.45% at 28,904. ASX 200 is down 0.45% at 6,740.90. And rounding off, we've got the Kospi, which is at 2,975.50, down just marginally 0.02%. What's your view of market action this morning rather?
I think there are two things going on. I mean, surely the big gust that came through was the relief that markets got from Wall Street. And so they're quite glad to see a NASDAQ-led rally on Wall Street and hoping it would spill over. But then again, we've also got a little bit slightly longer memories of how Chinese stocks were down yesterday, despite having heard whispers about the national team being in. So I think the question is twofold: whether the Wall Street rally is just a relief rebound, if we may allude to a dead cat bounce, and you could see a continuation of either a correction in valuations and or rotation continuing, or it is going to be a case of a slightly more optimistic outlook from here. And I think because the answer is not clear, that there is some caution, and I think it's somewhat more selective in terms of the buying.
Now, Vishnu, you brought up China as an example yesterday and it's really a study of contrast, because you've got China and the US. They're really contrasting in terms of their approach to stimulus. Now, the US being all in, China being far more restrained. Now, what's your view on this and how this will impact markets and currencies?
I think, at face value, it does jump out at you like a sore thumb. How can the two largest economies in the world take diametrically opposed approaches to managing the economy? You've got US, where the Federal Reserve is out and out in full stimulus mode. And the Treasury is also undertaking record fiscal stimulus. But we need to keep in mind that in the case of the US, the risks of not doing enough mean that they may not have come across very well, bearing in mind that the pre-vaccination trajectory of the economy during COVID was rather dismal. In contrast, China came out of it rather quickly. And in fact, China is thinking much longer term and holding the post-GFC experience close to heart. So they don't want financial stability risks to get out of hand. That's to say, credit will not be distributed indiscriminately. In fact, they want this channel towards the high growth and high technology industries, as well as they are also aware of a property market froth, and that's not good, whether in social terms or economic terms. So I think they're very targeted about what accommodation and stimulus should remain in place, and they want to steer the economy with their dual circulation strategy in mind. Whereas I think the US needs to rebuild a lot of capacity, and so they are willing to let the spigots be open. And the last point about this is that for the US, the dollar is the reserve currency. They've got a wide berth and a large margin of error in terms of the consequences of policy largesse. And a lot of times this actually spills over to the global economy and hurts the global economy for far longer than it does the US. So I think on those accounts, the policies fit the economies and their agendas.
Now, let's go on to look at somebody that's taking kind of a middle ground, the Reserve Bank of Australia. Now, they are walking a fine line in terms of stimulus. They're pushing yields lower, preferring a lower Australian dollar, but not basically whipping out the big guns to do so. What is your view on the tightrope that they are walking, and what could cause their strategy to unravel?
I mean, that's a very interesting case to watch because for a few reasons. I mean, for one, we don't think of Australia as a low yield economy. And now we have to move to a place where it is virtually zero rates. And so the RBA is trying to stress the point that move away from the old paradigms. And they're saying this virtually zero rates, 0.1% to be precise, is here to stay. So the RBA has batted away any considerations that they could move on rates soon. And they say lower for longer is the new norm. And I think in terms of yields, they're trying to push that message through rates as well as their yield curve control policy. They've got 3-year yields now better anchored. The question is what more they can do in terms of the longer and 10-year yields. And I think here they have shown a lot of flexibility in using the quantitative easing without pre-committing to expending that, because I think all central banks know post GFC that one of the problems is how do you unwind your balance sheet after the stimulus is needed. And I think the RBA doesn't want to bloat more than it really needs to. And the final point on the Aussie is an interesting one because the Aussie increasingly will come under stress. The tensions between very, very rapidly rising commodity prices that's pushing the Aussie up and the RBA that's trying to hold conditions easy enough. And for now, they've put this out there. It's interesting because they say they will not call it overvalued, but yet they would like it lower. Whether this can be interpreted as a sort of a currency manipulation or not is out there for question as well. So I think the currency path would be the very interesting path to watch, especially if the reflation trade keeps up and you continue to get a much stronger Aussie as a consequence of commodity prices. But for now, because USD yields on the upside is the risk and a consequent dampening of the Aussie dollar, I think the RBA is quite comfortable to say that they don't consider it overvalued as it is, but it's just a warning shot to say we are watching every corner of the field.
But one of the things with the Australians is the fact that, which again, it's the walking the tightrope, is the fact that while their domestic numbers, so retail numbers are good, employment numbers are good, but obviously that's also because of the second stimulus package that extends the package beyond 31st of March, JobKeeper and JobSeeker. But one of the spin-off benefits of this easy policy is the property market is looking decidedly frothy. So how is that then, in your view, going to impact their decision-making in terms of walking that tightrope?
I think that's a very good question, Brian. In fact, I think that is the definitive policy dilemma. The trouble with monetary policy, as it were, is that it is firstly blunt. Secondly, one policy tool can only achieve one policy objective. So you cannot both have quantitative easing to expand money supply and to reflate the economy, and at the same time want to rein in property bubbles or asset bubbles. So necessarily, asset bubbles would need to be nudged and coaxed by macro prudential measures. And that's to say what the RBA can do in terms of whether it is multiple property ownership, property taxes, the
quantum of loans,
quantum of loans, valuation metrics. I mean, this is a wide open field, but the point is they will need to, for credibility purposes, they cannot augment their approach in quantitative easing. So they need to accept this as a risk and then play the macroprudential cards as the things unfold, as the property market unfolds.
Now, what are the data points this week, an event that we should be looking out for investors that would move markets?
I think this week it is a rather quiet week, and I'm saying this very dismissively. Tomorrow is the ECB, so the ECB would be a key point to watch because of their concerns about long end yields going higher, to see what they may suggest. We don't expect any fresh policy moves, but anything that they suggest in the rhetoric or in the jawboning to talk it down, that would be interesting because it'll also be a point of reference for every other central bank that's watching this space and not entirely being sure what to do and the approach around it. So the ECB is, I think, the central watch this week for purposes broader than the Eurozone. I think the next big benchmark would really be the FOMC. The reason why I'm sort of dismissing data in between is because overall markets are accepting that any bumpiness in the data is par for the course, and they expect the overall improvement to stay in place. So I think it's really the policy tuning that needs to be watched. And here I'm already assuming that the $1.9 trillion fiscal stimulus will be passed in the US because it's along party lines, and the House ought to pass it.
Yeah. Thank you very much for being on the show, Vishnu.
My pleasure.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank on BizTech's Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.